If I had only $1,000 to invest today, I wouldn't invest it like a year ago. The current context is the reason. I'd structure it well from the start. No, I wouldn't aim to double it fast. We're in an environment of high rate, less liquidity, macroeconomic pressure, and huge tech infrastructure investment. This demands balance, not euphoria. With $1,000, I'd look for three things: a macro-backed sector, a small position with structural potential, and maintaining liquidity, as you've heard. Not to guess the bottom, but for margin. With that in mind, the $1,000 would be invested this way. Be warned, this is an educational example, not investment advice. 50% in an ETF like BOO, BTI, or CDCPX, because it represents the entire economy and doesn't rely on a single narrative. 30% in an ETF tracking the energy sector like XLE. Why? Because the real economy still needs energy. Data centers consume more and more electricity, and in high-rate environments, strong cash flow companies often resist better. 10% in a stock with structural potential, for example, Micron. Not for fashion, but because artificial intelligence not only depends on chip, it depends on advanced memory, and memory is one of the critical components for models to scale. It is not the center of the portfolio, it is a small position with a clear thesis, and 10% in liquidity or in a high-yield account. That's because today, rates pay, and flexibility is power. Look, with little capital, you don't need to hit a home run right away, but you do need structure, broad exposure, a correct thesis, and margin for maneuver, and that is starting with a cool head. Because remember, the error is using the same strategy in different contexts. Investing well is not just choosing assets, it is reading the moment. If you had $1,000 today, would you invest it all in one stock or like this? Follow my accounts on social networks to know important news first.